Good evening, everyone. A very warm welcome to the changes in ITR for annual year 2023-24 burning issues in income tax, international tax, and interplay of decisions in GST, organized by Tax Guru and Tax Connect. I would like to introduce our speaker, Mr. Vivek Jalan. Mr. Vivek Jalan is qualified chartered accountant, qualified LLM and LLB. He is the chairperson of the Indirect Tax Core Group of the CII. Also, he is the chairperson of the Fiscal Affairs Committee of BCCI. He is the regular speaker of various professional forums on the key areas of direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any query, please write in the chat box. We will answer all your queries at the end of the session. Now we request our speaker, Vivek sir, to take the session forward.
Thank you, Titli. Am I audible?
Yes, sir.
Yeah. Share my video. PPT. Yeah. Is the PPT visible?
Yes, sir.
Is the PPT visible?
Yes, sir. It is visible.
Okay. So, thank you, Mushmi, for the introduction and setting this webinar live. And thank you for to all the participants for joining this webinar. As usual, and in terms of our policy, we'll always start on time. While many of you have joined, many more will further join during the course of this webinar. But it's better to start on time, and we'll also try to stop on time. And thank you to Tax Guru for partnering with us and holding this webinar for the benefit of all the members of Tax Guru and various other professionals in taxation, in industry, as well as in practice. And as my colleague Moshmi said that we would answer all the queries, so please do keep typing on the chat box and we will answer. I see one query has already been asked, although privately, yet I will answer. But the query is in GST, although this is mostly a income tax webinar, but still, yeah, the query is that composition suppliers, will they be able to make interstate sale or not as per this budget? Answer is no. They would be able to make intrastate supplies through e-commerce taxpayers only. That is the amendment in this budget as far as GST is concerned. So in this webinar, friends, we would discuss, and there was a change. If you have noticed it in the topics, initially we had a few other topics that was also very exhaustive, but then again, the recent change, that is the ITRs have been notified by the uh, Ministry of Finance for the assessment year 23-24, and that is very, very important for all the taxpayers. Also, since this last year ITR was notified, I think in March somewhere, and ITR 7 came quite some time afterwards. But now they have notified ITR 1 to 7, everything almost within a matter of 2-3 days, and in February. So all of us have to be prepared for filing our income tax returns on time. There would not be, as far as we understand, and since ITRs are also being notified very early, there would not be any extension of the time limit for filing income tax returns. So we have to be prepared accordingly. Friends, other than this, we would discuss on the trust. I understand many of you who are in practice are doing trust income tax matters and GST matters. Many of you who are in industry, I see many of the participants, they are regularly our friends on our webinars. So they, while they are in industry, you would also be handling trust somewhere or the other. In income tax, if you ask, the major burning issue today, there are two. One is this 194 capital R TDS, and the other is the taxation of trust. We will dwell on everything, and as I say, burning issue, you will see the most amendments in the ITR have been made in ITR 7 relating to trust and charitable organizations. So we will discuss holistically on trust, including the Supreme Court judgments, what have been changes last year, this year, and the corresponding impact in the income tax 7 return form. We will discuss on global minimal tax, not that much because global minimum tax, you all know, is still a process in the making. We'll just touch upon there has been a new release on 2nd of February 2023, and there are many changes in the budget which will be implemented from 1st April itself. We will discuss on that, which is important for all of you to know. And not only what are the changes in the budget, now all of you know what are the changes in the budget and the finance bill, but what is the implication to your business, right? Not only in income tax but also in your business process. How do you change the business process, as well as under other laws, and mainly on GST, wherever we have delivered on the budget various lectures, I have always said that a tax professional, either in practice or in industry, cannot work in silos. You cannot say that, see, look, I'm doing income tax only, so I know nothing about GST. Neither can you say, I am working only in GST, so I will not discuss income tax. Every business decision will have GST as well as an income tax angle to it. So we will discuss on the interplay between income tax and GST with respect to various amendment made in this budget. In GST or in income tax, it will be payment to MSMEs, inventory evaluation, very important, CSR, new income tax regime, and certain TDS, TCS, as always, there are important, and certain changes with respect to non-residents and international tax matters which have been amended or which are burning issue today in income tax. So to start with the amendments in the income tax returns, I think that is the most important recent development which has come. We will discuss not the entire income tax returns, ITRs, you all know, but we will only focus on the amendments or the changes in the income tax returns for assessment year 22-23 vis-a-vis 22-23 which you have filed, right? So first and foremost, amendment. Just a moment. Okay. Yeah. So in ITR 1, we all know ITR 1 is a very, very simple form for uh, basically salaried taxpayers who have one house property, no capital gain, and some other income, right? In that, not much amendment is actually called for, required, or anticipated, and there is not much amendment in that. Only amendment is that ITR 1, they have deleted the clause wherein ITR 1 can be filed by any person who has deposited more than 1 crore rupees in a current account, because a current account will always be opened and operated by a person who is into business, right, or profession. That is why such a person will never file ITR 1. He will always have to file ITR 3. Therefore, this clause, as per the 7th proviso to section 139, that has been deleted from ITR 1. So, if you have a current account where you have deposited more than 1 crore rupees, even if you do not have a business income, you have to file ITR 3 and not ITR 1. Right? Now, new tax regime, old tax regime. I think all of us know now, especially after this budget, because all the amendment, all the relaxations to taxpayers, individual taxpayers, have been provided in in the new tax regime, right, under 115 BAC. Therefore, now in the new tax regime, how can you opt in and out of the new tax regime? In case you are not an SSE with any income under the head business or profession, then you can opt in and opt out every year. How do you opt in and opt out of the new tax regime? By filing Form 10IE, right? However, in case you are an SSE who has income from PGBP, then you can opt into the new tax regime in income tax. However, you can withdraw or opt out of the new tax regime only once during your lifetime. So, in case you have opted out of the new tax regime, then you are required to give, if you are a person with a income under PGBP, filing ITR 3 or ITR 4, because previously the new tax regime was only for individuals and HUF. It was not for AOP BOI. It has been introduced in this budget, right? So if you are an individual HUF and if you have income from PGBP and you have opted out of new tax regime back into the old tax regime, then you have to do three things. You have to provide in the ITR 3 or ITR 4, there is a place where you provide the assessment year in which you have opted out, the date of filing the Form 10IE, and the ARN number, the acknowledgement number of Form 10IE, through which you have opted out of the new tax regime and opted into the old tax regime again. ITR 3, there is a amendment even in the balance sheet, right? What is this amendment? If you have taken any loan from a related party under 48(2)(b, right? If you have taken a loan from your subsidy, etc. Previously, you had to club it with any other loans or advances and show it as one figure. Now you have to bifurcate advances taken from related parties under 48(2)(b and other advances, right? But correspondingly, there is no amendment where you are providing the advance to a related party, right? There is no amendment. So, amendment is only in the balance sheet in ITR 3 in case you have received advance from a related party under 48(2)(b, then you have to show that separately and other advances separately, right? So the intention is very, very clear. The moment you show a bifurcation, this bifurcation, then immediately you might get a query as to why such income should not be, the advance should not be added back, and in case this advance is seen continuing from a long period of time, it might be considered to be as your income, right? So Of course, after giving you an opportunity of being heard. So now this is a major amendment, although a small amendment in case if you see it, but if you see it minutely and the purpose of this amendment, then it becomes quite an important disclosure for taxpayers with PGBP income, right? In almost all the returns 2, 3, 4, 5, 6, and 7, previously, you could not file a return under section 153C. What is 153C? It is an assessment of a person other than a person in whose premise a search under 132 or 132A, that search and seizure, they were conducted, right? So in case a search and seizure was conducted or search was conducted in some assessee's premises, and due to that search, assessment is happening on some other assessee, right? Due to incriminating evidence, then the return will be filed by such assessee under 153C. Previously, that option was not available to file return under 153C. Previously used to file it under any other 142(1), etc. Now that option is there under all the ITRs 2 to 7. Every ITR now has an option to file the return under 153C also. There was an amendment in the last finance bill with respect to non-residents who are coming back into India and they have any income or withdrawal out of any accounts which are mentioned, which are opened out of India, and there is some income there. For example, those non-residents who have served an employment in a foreign country and they have opted for certain retirement benefits. But as we all know, retirement benefits take them some time to come, right? So they have come back to India. Retirement benefits come back after some time. However, in India, tax is paid on accrual basis. So there was a genuine hardship, and therefore section 89 capital A read with rule 21 triple A were notified to provide that for certain specified countries, and there are I think 3 or 4 countries specified under rule 21 triple A, that such assessees who come back to India and now they are taxable in India because from NRIs they have become residents, for such income which they receive in particular financial year, which would be taxable under the foreign laws in that particular financial year in which the income is so received, and corresponding the foreign tax credit would be received in that year in India also, it would not be leviable to income tax on accrual basis. So for example, in financial year 21-22, you have come back to India. So when you were filing your income tax return for assessment year 22-23, you would not have shown this income at all, right? Because the income would have been received, say, in the current financial year 23-24. However, there was no column or no table to show the deferral of such income. The fact that you have taken a benefit under 89A, there were only two columns to disclose whether income is from retirement benefit is in a notified country or not in a notified country. Now an additional row has been added to show that you have deferred this income under 89A. You have taken the benefit of 89A, not offered this income to tax in this year, but you will be offering that income to tax in the subsequent year when it is received and when it is taxed in the foreign country, right? So now you have to specifically disclose this. Therefore, the income tax department can always track this And in future, if you do not offer this income for taxation, then it would be tracked and offered for tax by the income tax department on assessment. So this is you know change due to an amendment in the last finance bill. The biggest change in the last finance bill 2022, not this finance bill, last finance bill, was the introduction of income tax on virtual digital asset, popularly called crypto tax. What was that amendment? Well, 247A was notified to define what is virtual digital asset, just to lay down the perspective so that you can understand this schedule which has come in the income tax return 2 and 3. So 247A defined virtual digital asset to be a token, code, etc., which was digitally received, right? Now, in case you transferred a virtual digital asset, then it was specified subject to certain conditions, you would be taxed under any head of income. The head of income, you have to decide whether it is PGBP or capital gain. But in whichever head you are taxed, the tax rate would have been a special rate of 30% under section 115 BBH. And correspondingly, the transferee who was paying the transferor for such virtual digital asset or crypto, he would have to deduct a TDS of 1% under section 194S, right? The only deduction which was available from the consideration was the cost of acquisition of such VDA, virtual digital asset. No other expenses would be allowed as a deduction, right? So this was the taxability of virtual digital asset. Therefore, corresponding to such change, this time in the ITR, this schedule has been brought in, ITR 2 as well as ITR 3. In ITR 2, this schedule is only to the extent of capital gain, where virtual digital asset income would be considered to be a income under capital gain. In ITR 3, this schedule has come in twice, where virtual digital asset income would be considered under either capital gain or under PGBP. There are 7 columns in this schedule VDA. Most important, friends, you will see the highlighted portion on your screen. A question was always asked and it was answered by the CBDT from day one. However, some taxpayers still had the confusion. Although CBDT, I still remember on 2nd or 3rd of February, the Joint Secretary in Ministry of Finance, he had clarified very clearly that each transaction of this VDA, virtual digital asset, would be considered to be as a distinct transaction. Why this was there? Because a loss from a virtual digital asset transaction would not be considered to be or would not be available to be set off against any other income. So the question was, say you have 10 transactions where you brought and sold 10 times VDA, and if you incurred losses in 5 of them, but you earned profit in 5 of them, however, net you are at zero gain. will there be no tax in this whole 10 transactions of VDA? It was always clarified by the CBDT that each transaction of VDA would be considered to be as a distinct transaction, right? And a loss in one transaction would not be set off against a income or a gain from another transaction of VDA. Hence, they have now very clearly distinguished each such transaction. Friends, see column number 1, where serial number, you have to give a serial number of each such VDA transaction. Date of acquisition of the VDA, date of transfer, head under which income to be taxed, because it is picked up from ITR 2, it is only showing capital gain. We will come to PGBP after this. You have to give the cost of acquisition. In case of gift, you have to enter in case you have offered some amount for tax under 56 to 10 early, 56 to 10 earlier, right? So that if it is nil, it is nil. And consideration received. So now consideration received, column number 6 minus column number 5. That would be the income from VDA, which would be reported in column number 7. But as I said, most important, you see the heading, it is very clearly stated enter nil in case of loss. That is 6 minus 5, right? So in case in any transaction you have a loss, you have to enter 0. Only those transactions where you have a gain, you will be taxed at the rate of 30% under section 115 BBH. Whatever the total comes of column number 7, again it is said sum of all positive incomes, right? So everything is very, very crystal clear in this schedule itself. So this total has to now go to C2 of schedule C, capital gain, right? This is where this total of column 7 goes, right? So I suppose now it is very, very crystal clear this schedule VDA. Similar schedule will be there for PGBP. Schedule VDA is there for PGBP in ITR 3 also. Set off of current year capital loss with capital gain in case you have any capital loss where you are offered the benefit of DTA, then the capital loss would not be allowed to be set off against capital gain of the current year. And A8A and B12A, that is specifically excluded in this set off table. Now, in ITR 2 and 3, it was there already in ITR 5 and 6. And previously in ITR 2, 3, it was there for dividend, etc. You have to specify the capital gains, short term or long term, which has been accrued quarterly. Very important, friends. So why is this required? So every quarter, previously there was always a question, right? And sometimes it was against the taxpayer also, that in case a capital gain has accrued in the last quarter of the financial year, then they would be charging interest under 234C on the entire year. Interest would be charged, and then you would have to get it set off in the assessment time. Now they have introduced this schedule where you have to disclose quarterly what is the capital gain you have earned in every quarter, and your interest under 234B and C, that would be calculated on the basis of this table, right? So very, very important, again, this schedule which has come. Another important development in ITR 3, 5 and 6 in the profit and loss accounts which are appearing, you have to now bifurcate the intraday trading of securities and the delivery based trading of securities. So intraday trading of securities, that will go under speculative income. Delivery based, that will go in non-speculative income. Although at the end of it all, it would all come as PGBP income. However, this is to distinguish the speculative with non-speculative income, because the speculative would not be adjusted against the non-speculative income, the speculative loss. Now, very important is 12A and 12B. There are two rows, right? As you see on your screen. Row 1 is turnover from intraday trading, and row 2 is 12B is income from intraday trading, which has to be transferred to profit and loss account. Now, what is turnover of intraday trading, right? What is turnover in speculative trading, right? It is the gross of positives and negative gain. So you add up all the positives, that is gains, as well as you add up the absolute value of the losses in trading, intraday trading or speculative income, and that gives you your intraday trading turnover. And the net, that will be shown under table 12B, which would be going to your profit and loss account. So, to that extent, it is very important for the speculative intraday trading income. As I said earlier, the same this VDA, that is schedule VDA, that is there in ITR 356 for PGBP also. So in PGBP, you will see taxable under 115 BBH, net of cost of acquisition, no other expenditure is to be deducted. Again, in PGBP income, in ITR 3, 5, and 6, you have to choose between. So in ITR 2, this VDA is only for capital gain. In ITR 3, 5, and 6, it is you can choose which head, PGBP or capital gain, right? In whichever head you want to take this income to. So friends, these are the amendments in ITR 1 to ITR 6. There are most amendments is in ITR 7, right? As we have seen in the last Finance Act and the current finance bill in this budget, the intention of the government is very, very clear. They want to be very sure that the trusts are doing genuine business activity, genuine activities in the nature of charitable activities. So all the trusts, non-profit organizations who are taking exemption under either of the two schemes, we all know there are two regimes of trust. One is under 1023C, that is for medical hospitals, educational institutions, universities, schools, colleges, etc. And the other is under section 11, 12A, 12AB, etc. Right? So there are two regimes. We will call 1023C regime 1, 11 section 11 as regime 2, right? So before we go on to ITR 7 amendments, right? And as I have discussed in the beginning of this webinar, there is a lot of changes in the last 2 years in NGOs, trusts, or any non-profit making organizations taxation. So let us understand very, very clearly and in very short, right? Because if you read two Supreme Court judgments, those judgment itself go into 100 pages or so per judgment. If you see the finance bill, even if you go through the memorandum, in the last two memorandums for budget, the trust itself has gone into 20 pages each, leave alone the finance bills. So first, let us understand what is the ecosystem which is being created as far as taxation of trusts are concerned. Then we will go on to the amendments in ITR 7, and I will show you distinctly why these amendments in the ITRs have come and what would be the impact of the amendments in the ITR on the taxation. So first, what are the amendments in this year's budget as far as trusts are concerned? It was seen that you all know that for the trust in both the regimes, regime 1, 1023C or section 11 regime, say regime 2, both the regimes, the trust have to apply every year 85% of their receipts for achieving the objective. They can accumulate only 15% of the total receipts. How can they apply these 85% receipt? Either they spend the money themselves or the receipts themselves, or they donate to some other trust with similar objective, right? Also, in the last budget, it was provided that Mr. Chetan Joshi is saying voice gone. Moshmi, am I audible?
Yes, sir, you are audible.
Audible, yeah. Okay. So in the last budget, it was also amended that the trusts now they cannot uh, treat expenditure to be applied in this 85% in case they have not spent this money. So now it will be this application has to be seen on payment basis, right? It was seen that what trusts were doing to meet this 15% criteria, they were donating to other trusts and they were creating a chain of trust. So now it has been provided in this and proposed in this finance bill that when they are donating to some other trust, the donation to other trust would be considered only 85% application. So in case one trust donates to other trust for the purpose of application, only 85% of the amount of the donation is to be treated. Again, many trusts, what they were doing when they wanted to get out of the exemption, they just didn't reapply for exemption. But that was not what was intended. In the last budget, 2022, it was proposed and notified later that in case a trust want to come out of exemption, they have to pay exit tax. What is exit tax? That property which the trust have accumulated over the years from exempt income, the fair market value of the asset minus the fair market value of the liability, that was to be treated as the exit tax, the tax on that amount. So this time it has been reimposed. Streamlining the process of application, there was a technical glitch wherein in case of a new application also it was considered that the application has to be made 1 year before the 1 month before the end of the financial year. Now that has been rectified and it is now clear that for the new registrations in a year, the application has to be made before starting the activity. Return filing for trust, major change this year, right? So, as of now, what needs to be done is you have to file in case of trust which require an audit. You have to file the return of income by 31st of October. You have to file the audit report by 30th of September. However, there is a statement of accumulation in regime 1 and regime 2 in form 9 and form 9A and form 10. That statement of accumulation has to be filed on 30th September also. That is 1 month before the ROI is filed. And the auditor who is filing his audit report on the same day, he has to give a compliance whether this statement of accumulation has been filed or not. So now they want to streamline it. So now the process would be on 30th 1st of August, you have to file a statement of accumulation in form 9A or 10. On 30th of September, you have to file the audit report in form 10B or 10BB in regime 1 and 2. And on 31st of October, you file the return of income in ITR 7, right? Now, in the last year itself, it was provided that in case a loan is taken by a trust or a corpus donation is received by a trust, then the application out of that loan or the corpus would not be considered as application to the extent of 85%. The application would be considered only when the loan is repaid or the amount is redeposited to the corpus fund, right? And invested according to section 11. But it was seen previously, many trusts, they have already taken the amount as application in the year in which they have spent the money, right? So it is provided, and rightly so, in this budget. In those cases, naturally, they cannot take a double deduction once they have already taken, and now on repayment of the loan or redeposit in the corpus, they will take the deduction again. That does not happen, and that is why it has been provided, and specific place has been provided in the ITR to state whether you have already taken a deduction for application of the accumulated fund of the loan and the corpus. Now, you all know that as per the new regime which started 2 years back, all the trusts, even if they were already registered, they needed to apply for provisional and final registrations. If they are newly registered, they had to apply. And the system of granting the registration, that was automated. Now, many applications just went through. However, it was very clear in the new scheme of trust itself that such trust, every 5 years, they would be audited and they would have to reapply for fresh registration 6 months before the end of the fifth year. Now they have amended even the registrations. They are saying that, look, we have granted you the registration through an automated process, but it is not that you will be only audited in the fifth year. If the commissioner feels so, then he can audit you currently, and in case he feels that there is a specified violation or the registration has been taken in when you were actually violating the provisions of section 11023C or 11 or 13 or 12A, 12AB, then the registrations can be cancelled also, right? So to this extent, it is not that once granted, all granted for 5 years. So these were the amendments in the current year. Now there were certain amendments in the last year. One is books of accounts would have to be maintained. Certain penalties were proposed for violation of the provisions of the Act. Exit tax, as we discussed, and 85% accumulation. This was provided. And as I said, if you see point number 8, we have already discussed. Last year, it was enacted that the application of the receipts would be considered an application on payment basis, not on accrual basis. Friends, in this backdrop, there were two Supreme Court decisions in the matter of trust. One is the Honorable Apex Court decision in the case of Ahmedabad Urban Development Society, and the other is New Noble Society. And there is confusion galore across on the application of these Supreme Court judgments. Friends, let me all tell you, after these Supreme Court judgments and in this budget 1046A, has also been introduced to distinguish the Ahmedabad Development Authority judgment for the authorities, boards, etc., which are belonging to the government. So now I feel that all the trust, non-profit organizations should review their working and operations, and from 1st April 2023 they should restructure their entire operations apropos these amendments and apropos these Supreme Court decisions. We will discuss in very brief. We will discuss only 5 6 points which are the conclusions out of these Supreme Court judgments and how you should structure your operations. So, first, let us take the smaller judgment, New Noble Society, right? By smaller, I mean a distinct judgment. So, let New Noble Society that was in respect of 1023C, Ahmedabad Urban Development Authority that was with respect to Section 11. So 1023C, that is the first regime, New Noble Society, for that also for primarily the educational institutions in 1023C, not for medical institutions. And Ahmedabad Urban Development Society is for Section 11. New Noble Society judgment that was for Section 1023(6). Very, very distinctly and clearly. In this judgment, the Honorable Apex Court held and it discussed on the word solely, which is used in 1023(6) on your screen. So 1023C6 that provided that any university or educational institution which is existing solely for the purpose of education and not for the purpose of profit, that would be provided the exemption. Now, the previously in Surat Art Mills case of the Honorable Supreme Court judgment itself, it was held and this doctrine of predominant objective that was upheld in various other decisions. Now, what was this doctrine of predominant activity or objective? The doctrine of predominant activity provided that even in case a non-profit organization or a trust, it indulges in other activities, but the predominant activity is for the purpose of charitable activity. So if predominant activity is charitable activity, then even if the ancillary activities are not per se solely charitable, even then the exemption would not be denied. Now, in this case of New Noble Society for Educational Trust, it is held by the Honorable Apex Court that educational institutions who are not solely into the activity of educational purpose, they would not be provided exemption for that part of the activity which is not solely for educational purpose, even if they are incidental or ancillary to such educational purpose. So let us understand by means of an example. In case there is a school, the school provides books to its children, that is educational purpose, but the school also has a shop, a book shop for in which it sells the books. It may be that the profits out of that bookstore where it sells to outsiders, that is applied for the benefit of the school itself, yet it would fall under the specific violation of 1023(6), and that part of the income for the bookstall that would not be considered to be as exempt. separate books of accounts have to be maintained, and post that section 11(4) and 4A, that has to be harmoniously construed, right? So no new noble society, clear, distinguished. Now, Ahmedabad Urban Development Society. Ahmedabad Urban Development Society primarily held on 215, section 2 subsection 15. Section 2 subsection 15 defines charitable purpose, and 215 can be divided into two parts. First part, it defines charitable purpose as 6 activities, right? They are the first part. And the second part, it defines charitable purpose as object of general public utility. Friends, let us first be very clear that this judgment of Ahmedabad Urban Development Society is only for the GPU, general public utility purpose. It does not include any trust or non-profit organization which carries on its activity, which are for interstate charitable purposes like relief to poor, education, yoga, medical relief, preservation of environment, and prevention of monuments. So, education and medical relief, this is covered in 1023C. Education specifically in New Noble Society, if you are registered under 1023C, then New Noble Society would be applicable to you. Otherwise, it would not be applicable to you if you are registered under section 11. Now, proviso was added in assessment year 910 to this 215. What was the proviso? The proviso stated that advancement of GPU object, general public utility object, and most of the trusts are registered under this GPU. And we will show you in your return of income when you file ITR 7, all of this is important. So if you are registered for GPU, the provision provides that it shall not be considered as charitable purposes if this trust involves itself in carrying out any activity in the nature of trade, commerce, and business, or an activity which is carried out for any consideration, right? So, proviso, if you just read this part, any activity, any trust which is registered for general public utility activity, and if it carries on any activity in the nature of trade, commerce, business, then for a consideration, then the exemption for charitable purpose under section 11 would be denied, right? However, there are two exceptions. In case the mischief of trade, commerce, business is done, or an activity in the nature of trade, commerce, business in done in the course of actual carrying on advancement of general public utility, and if the threshold or aggregate received of such activity is less than 20% of the total receipt of the trust, then you can carry on such activity within the mischief of trade, commerce, business, right? So this is the understanding, right? I will just sum up, right? I will take 5 more minutes in trust, and then I will go on to the other topics. This is very important discussion. That is why we are giving a little more time to this discussion. So what are there are 4 conclusions out of this Ahmedabad Urban Development Authority judgment, right? First, it is not applicable to inter se activities. like education, medical relief to the poor, medical purpose, etc., medical relief, etc. It is applicable only to those trusts which are registered to achieve object of GPU, general public utility. Number one. Number two, in case the trust carries on any activity which is under the mischief of trade, commerce, business, and which is not for advancement of the or in the course of the predominant activity, then exemption would not be provided for such activity. I will discuss by means of an example. So, second gone. Third, in case there is a activity in the nature of trade, commerce, business, but it is in course of the GPU activity, then exemption continues provided the aggregate receipt of this activity in the course of furtherance of the, or in the course of the business of the actual predominant activity or object, if the aggregate receipt is not more than 20% of the total receipt, then the exemption continues. So, example, we will continue with the same example, right? If you have a school registered under section 11, the income from the fees, etc., everything is exempt. That is the predominant activity, right? While this is for inter se, let us understand this, and then it can be applied to GPU. Now, in case you have a bookstore, it is in the course or furtherance of the school's activity. That also would continue to be exempt provided the receipts from the bookstore are not more than 20% of the total receipts of the school, right? So this sums up Ahmedabad Urban Development Society. While again, as I said, this decision is not for inter se activities, and education is also an inter se activity. However, this would apply to GPU in case you are registered under GPU activity. So let us take another example. In case a chamber of commerce is registered under section 11, the membership fees, predominant object, totally exempt, no problem. However, if it runs a restaurant, right, or if it does any event where it earns more than nominal profits, and that has also been defined, then that would be considered as in now this restaurant, that is not the activity of the chamber of commerce, that is not in course of the activity of the chamber of commerce, then it would be denied the exemption for that activity. But if it does certain education event where it earns supernormal profit for the promotion and protection of trade and commerce, then that would be continue to be exempt because it is in course of the original or the predominant objective. And however, the receipts from that activity of sponsorship, etc., or event, that should not be more than 20% of the total receipts or from all activities taken together. So friends, this is the conclusion from this Ahmedabad Urban Development Society, right? This PPT would be shared to you. You can go through this. In this backdrop, let us understand while filing ITR 7 this year, what changes you would have to make. So first is a general. Now, all the changes primarily are for this accumulation. While they want you to file a separate form 9A or 10 for accumulation, in the return itself, they have amended tremendously for the accumulation. There are new schedules. For accumulation in the current schedule I, for accumulation of the receipts to the extent of 85%, they have added few columns. So what is the column? Amount taxed in any earlier year. So this is for amount accumulated, right? So this 15% which you are accumulating, if you have offered it to tax in any earlier year, you have to specify that, so that this is not offered for tax again. So they want to, assessment year wise, they want to track. If you have 100 rupees receipt, and if in a particular year you have accumulated 20, if you have offered 5 rupees for taxation in that year, then in the next year you would not be taxed, or after 5 years, at the end of the fifth year, you would be taxed on this 5 rupees. Amount credited or paid to the trust or institution, right? So now they are tracking this also. As I said, in this budget, they have specifically provided that in case you are donating, you yourself are a registered entity, registered under section 11 or 1023C, and you are going for application. If you are going for application of your receipt by donating to some other trust, then only 85% of that donation would be considered to be as application of funds, right? So here they have now distinctly, now they have started distinguishing this kind of donation to another trust for the purpose of application. From next year, only 85% of this amount would be considered to be as application. They have added a new schedule IA, right, for this accumulation amount which you have taxed earlier. As I said, in column 6, they now have a complete table also. This is a new schedule. Again, for deemed application, there is a new schedule itself, right? So deemed application also, they are now tracking. Schedule J, right? Amount taxed. Again, Schedule J is for amount statement showing the funds and investment as on the last day of the previous year. So even investments, they are tracking. If you have invested in a scheme, or if you have invested in a fund which is in violation of section 11, then you have to offer it for tax. So they are tracking even that. In case your investment is in violation of 11.5, then you have to offer it for tax, and you have to disclose it separately now, right? And in the balance sheet also, out of your total amount of funds, you have to disclose. If you see at the bottom of this balance sheet in row 6 and 7, out of the total funds, amount investment invested in modes under 11.5. So if you invest in shares, any money from your trust, then you have to disclose it in 7. Invested in any other mode other than 11.5, and you have to offer it for taxation, right? So again, Schedule A is a new schedule, but this they have total track. They are tracking what amount you are receiving, under which clause of 215, inter se clauses, those 6 clauses or GPU you are receiving, what amount is applied, what is accumulated. They are tracking separately in this Schedule A. So friends, now, so what we have understood from this entire discussion of trust and non-profit making organization, Income Tax Department wants to track 3 things. Number one, it wants to track your receipts. Number two, it wants to track your application and accumulation, right? Out of 100 rupees, this first receipts, whether you are receiving what you are receiving, whether it is for charitable purpose or not. If you don't receive it for charitable purpose, then immediately make separate books of accounts for those activities which you are doing not for charitable purposes, and offer it for taxation. Number two, if you out of 100, say 80, you say, I am actually receiving this money for my charitable purposes under GPU. Then out of these 80 also, they want that 85 application, you have to be very clear that out of 80, 85% you will apply every year. And if you accumulate the 15%, they want to track. Accumulation should not be on an average more than 15% for 5 years at period at a time. And last, they want to track whether this 15% accumulation, whether you have applied it, invested it correctly under section 11.5, whether or not you have utilized it or misutilized it, I would say, as per section 13 for some trustees or some related parties. So I would say a three-way mechanism to control trust: control the receipt, control the application and accumulation, control the investment, right? Now, few burning issues and their corresponding impact. In this budget, we have already discussed. If you have attended our 2nd February workshop webinar, in this budget, there is a very, I don't know whether to say as a welcome amendment or not welcome amendment, but there has been an amendment which is cited as a social welfare measure. And my respectful submission is, maybe in the short term it may not provide the desired result, or it may provide adverse result. If you are a micro or small enterprise registered with the MSME department, then when people purchase from you, they may stop purchasing from you in the short term, but in the long term it would help you. So what is the amendment? Only for micro and small enterprise. Many people are making mistake. They are saying MSME registered enterprises. No. Even if you are MSME registered enterprise, only if you are micro and small enterprise, then for payment to you, the payment has to be made by your customer within 15 days. If there is no contract, within the contract period, if it is less than 45 days, or maximum within 45 days, even if there is a contract and the contract period of payment is more than 45 days, right? Now, the fact is that this is an income tax add back under section 43B. So under 43B, your customers would only be given a deduction in case they have made a payment to you within 15 days or 45 days or contract period if it is less than 45 days. This compliance has to be seen only on 31st of March. Correct? Therefore, during the year in 23-24, this will become applicable from financial year 23-24 relevant to the assessment year 24-25, right? So, even if the whole year your customers, your big customers, especially PSUs, I would say PSUs give the delay the payment the most, I would say. So all your big customers, the whole year, they will keep on delaying your payments because they have no impact. However, on 31st of March 2024, friends, all your customers will clear your payments because the compliance with section 43B H amendment, that will be tracked only on 31st March 2024. So to that extent, there is a benefit. Now the question is, this 15 days, 45 days, when does this start? This is an amendment which is just like or in the same nature of this GST second provision to 16(2) amendment. Even in GST, if you don't pay your customer within 180, with your supplier within 180 days, then you will not be getting the benefit of ITC. You would have to reverse your ITC, right? So in the same vein, this amendment has been proposed, right? However, in GST, mind that there is a difference. And as I say, I will do interplay between GST and income tax because you have to customize your business operations accordingly. In GST, it is 180 days from the date of the supplier invoice. But here, if you read sections 15 and 16 of the MSME Act with section 45B, 43B, then it is clear that the start date would be the date of receipt of the goods or services. Clear? So this is a major difference. So this 15 days or 45 days, it will start from the date of receipt of the goods or the services. As of now, even every quarter, right? So now if you are the customer and if you are not complying with this 43BH, every quarter you are paying advance tax. Is there any implication on that? There is no implication. There is no implication of interest for non-compliance with 45BH during the year while making payment of advance tax. But if you are non-compliant with 45BH, or if you fall under this 45BH, that is the right term to use, then interest for the whole year under 234C or 234B, as the case might be, that would be applicable. Clear? Another, friends, very important amendment in this budget, and again I would do interplay with your business operations and with GST, is section 142 amendment. Now, what is this amendment? The amendment states that in case during the course of the proceedings before him, where books have been requisitioned and assessment is going on, during the course of the assessment or proceeding, if an officer feels that due to the nature and the complexity of the transactions or any other reason, he would like to get an inventory valuation done, then he would take a permission from the chief commissioner, principal chief commissioner, or commissioner, right? So, commissioner or chief commissioner, both, to get an inventory valuation done by a cost accountant. The fees of the cost accountant would be paid by the central government, correct? Friends, what is most important is the small amendment to section 142 subsection 3, which goes unnoticed. What is the amendment to 142 subsection 3? The amendment to 142 subsection 3 provides that in case during the course of such inventory valuation, any incrementing material, any incrementing evidence is unearthed by the cost accountant, which might be useful for your assessment, the assessing officer can use such material or evidence for the purpose of assessment. Only an opportunity of being heard would be provided to you. So in case certain unaccounted cash is found during the inventory valuation by the cost accountant, then such cash would be the incrementing evidence or material on the basis of which your assessment would be decided by the assessing officer. So this amendment 142.3, this widens the scope of your assessment to a on-site audit, right? Although this on-site audit was there already, but in the garb of inventory valuation only, an on-site audit might be conducted, right? So let us be careful about this amendment, and inventory valuation, what we report during the return filing period or during our tax audit, That is very, very important, friends. Now, there was a very critical, now, this inventory valuation, this would have an impact on GST in case any inventory valuation defect is found for which there is a liability in income tax which is generated. And if you admit such liability, there would be a corresponding liability in GST. And there has been cases very recently. The Honorable ITR Kolkata has decided in the case of Shiv BD Manufacturing Company. Now, what was the case? During the course of the audit, the VAT authorities, right, found out that there is some inventory which is excess. Now, what the business was doing, it was getting the stock of raw material not in its registered premise, but on in a field close by. Now, the inventory which was received in the field, that inventory was also added to this ERP inventory or book inventory. Now, the VAT authorities, they investigated and they demanded VAT on this inventory, which was like in the open field as unaccounted for inventory. To buy peace, the taxpayer, he admitted the demand in VAT, and correspondingly a demand was made in income tax. The Honorable ITAT Kolkata in the case of Shiv Bidi manufacturers held that income will be only the real income, not notional income. The income for income tax purpose, only the profit based on the gross profit margin of the SSE, only that would be taxed in case of this inventory mismatch. Friends, the same analogy would be applied to this 143, 142 inventory valuation. In case you admit any tax in income tax, in that case, then a corresponding liability might accrue in GST on the turnover or estimated turnover. CSR, again, 360-degree approach. Why I say 360-degree approach? It is because CSR is allowed or it is mandatory under Companies Act section 135. Under Income Tax Act, before assessment year 15-16, it was allowed under section 37(1). The tax authorities disputed, but tribunals held in favor of the taxpayer, saying CSR expenditure is not an appropriation of profit, it is a business expense without which business cannot be conducted. It should be available for deduction under 37(1). But thereafter, explanation 2 to 37(1) was added in the Income Tax Act, and from that day, all the tribunals held against the taxpayers. So, primarily from assessment year 15-16, CSR expenditure is not allowed under section 37(1) due to second explanation to 37(1), right? However, it is important to note that the CSR expenditure would be allowed under section 30 to 36 because amendment is made only to 37(1). So, in case you are doing any repair work to your building which you are availing under CSR expenditure, then that should be available under 30 to 36, which is not barred by Income Tax Act. The next question which is to be asked is whether this CSR expenditure which you are donating to a trust which is registered under ATG. So, for this CSR expenditure, ATG benefit is available or not? The tax authorities have contested this on two grounds. One, as per the memorandum in assessment year 15-17, when this disallowance under 37(1) was introduced, the authorities contest that if a deduction under 80G is provided for CSR expenditure, it would result in subsidizing the CSR expenditure, which is not as per the intention of the statute. Also, they say 80G is a voluntary donation, whereas CSR is a mandatory deduction. And therefore, 80G would not be available for CSR expenditure. However, the taxpayers contest on the doctrine of expressio unius est exclusio alterius. Right? A little technical. In simple words, we have been using this doctrine where anything in the tax statute which is exclusively mentioned, it excludes all others. Which means in case a disallowance is specifically mentioned under 37(1) for CSR expenditure, it excludes 80G, right? So for the purpose of 80G, if you are spending your CSR funds, then 80G would continue to be available for the CSR expenditure also. The same was held in the case of Marsh McLean Global Services India Private Limited versus Assessment Unit by ITAT Mumbai. And there are other judgments also on the same grounds holding the same ratio. Under GST, a major amendment has been made, proposed in this finance bill, wherein 17.5 FA has been proposed, disallowing the ITC on the CSR expenditure where such expenditure is apropos section 135 of the Companies Act. So in case you are spending some money for your CSR expenditure as per section 135 of the Companies Act, then ITC for such goods or services would not be available. Question is whether this ITC would be available till the time when this 17.5 FA is notified. Friends, our respectful submission and legal submission is that the very fact that 17.5 FA has been would be notified, which means that now there is a specific disallowance, and therefore before there was this specific disallowance, the CSR expenditure ITC for goods or services would consider to be available. So till the time 17.5 FA is notified, CSR ITC would be available. Post notification, ITC on goods and services for CSR activities not be allowable. However, friends, one other conclusion is that in case you are spending for CSR in excess of required under section 135 of the Companies Act, or where you are not at all required under the Companies Act to spend for CSR, still you are spending for CSR, in that case, there is no disallowance of input tax credit on goods or services for CSR activities. Clear? So, CSR, as I said, we have to take a holistic view. Well, you see, new regime versus old regime, we have discussed this. There have been lots of discussions on this. Our only, values which we can add on this, you all have gone through this, is that many people consider that this new regime under income tax, no deduction is available. Friends, you have to revisit this 115 BAC, subsection 2, 3, 4, right? Only those spends as mentioned in subsection 2 of 115 BAC, they will only not be allowed as a deduction or exemption in the new regime also. Other than this, everything would be allowed. So, what all exemptions or deductions are allowed in the new regime, number one, we are not going through this 87A and slabs and all. You have all gone through this. You can go through this PPT also. We will discuss only the exemptions or deductions which you can still claim. Number one, after this Finance Act, standard deduction of 50,000 for salaried employees. Number two, family pension under 57(2)(a) after this budget. This is an amendment in this budget. Number three, 80 CCH for this uh, Agniveer scheme, right? Then there are other deductions which are available to you, like Section 10, subsection 15, that is interest on gold deposit certificates, or 3,500 or 7,000 on post office savings account interest. So, friends, there are various other deductions in this scheme also, which please go through this. This is a small chart. Well, you can go through this at your own pace. There are various amendments in international taxation also, or for non-residents. Well, now even a non-resident who becomes a not ordinarily resident, and in case a gift is given more than 50,000 to him, even then that gift would be taxed. 5627B, this is a major amendment, angel taxation. It was not applicable to non-residents. So now if your company receives certain funds even from non-residents, wherein the premium of the share capital is more than the fair market value, then under 5627B, just like residents, even funds received from non-residents would be added back under 56(2). A very welcome amendment in this budget. You will see the next return which comes out for next assessment year is that in case you offer your income for taxation this year, TDS is deducted next year. So there would be a section in your income tax return wherein you can claim that TDS also after declaring that you have not claimed that TDS anywhere else and you have already offered the income in the last year. So there is a linking which would be required of your income vis-a-vis your TDS, and you can claim it henceforth. There are various other TDS on online gamings, 194BA on online gaming. Well, many of you would have as a taxpayers, clients, or for your individual purpose, if you are playing on online games, right, and if you have net winnings, that is profit minus losses, then at the end of the year you would be taxed, right, on that accumulation of net winnings in the online game. But if you want online game, if you want to withdraw some money during the year, then TDS under 194BA, that would be applicable on the withdrawing. TCS, very, very important. I was quoted in one of the media, I think Business Standard or something. So one of the bankers said, see, now if you are transferring under LRS to any person outside India, including your child or relative, right? Then if you are transferring for educational and medical purpose, then TCS is 5% with a threshold of 7 lakh. If you are transferring for any other purpose, then TCS, including tour operators, TCS is 20% without any expenditure. To understand this provision, from 1st July 2023, if you are remitting any foreign exchange out of India under LRS, other than educational or medical purpose, I will come to this educational or medical purpose also. Other than this, if you are remitting any money, say you are remitting 1 lakh rupees, then you would have to remit 1,20,000. The bank would deposit 20,000 in TCS, which you will get a credit after the end of the year. So one of the bankers was saying, see, whatever you want to remit, please remit before 1st of July 2023. right? So, some tax planning there. But important is the meaning of this word educational purpose. Now, if your child or your relative, say, is staying in a university hostel outside India, then it would come under educational purpose. But if your child or relative is staying outside India in a flat, then you cannot prove educational purpose, and then this TCS would continue to be applicable. So, this purpose is very, very critical, and you would have to kind of give evidences whether it is for educational purpose or medical purpose or for any other purpose, right? Market linked debentures, there is a TDS under interest on debentures. There is a new TDS of 10%, even if they are listed, and MLDs, there is a new tax under 50A, market linked debentures. Okay, since we are almost time and we will take certain questions also. So last, global minimum tax. We all know that there are two pillars to global minimal tax. I would share this PPT with you also, and you can go through this. Just an update on global minimum tax. Friends, global minimum tax, pillar 2, that is on target to see light of day on 1st of January 2024. So all the professionals who are in practice, this is an area, professionals who are in industry, and where your companies would fall under pillar 2. This is an area which would be evolving and most complicated after international taxation. This is international taxation actually. So globe rules have already come, and now new administrative technical guidance is out on 2nd of February 2023. This technical guidance gives a further understanding of globe rules, right? And the implementation of globe rule. For example, just let us go through this example very quickly in 2 minutes. So if you have headquarters, your tax rate in headquarters is 30%. Income is 1000 crores in your headquarters, you pay tax of 300 crores. Subsidiary A, again, tax rate is more than 15% global minimum tax rate, so you pay. Subsidiary B, right? Here you have a loss, so no requirement of tax. Now, subsidiary C, while if you see the total income, right, of your MNE, multinational enterprise, if you take headquarter and subsidiary A, you would have actually paid 700 crores, which is more than the 15% tax globally. However, subsidiary C, you have 4,000 crores of income where the tax rate is nil. So still you have to pay 600 crores of tax in subsidiary B, even when globally you would have paid more tax. So this is called qualifying domestic minimum top up tax. This administrative guideline has been issued on 2nd of February 2023 to take care of administrative issues in this implementation of GLOBE rules. So those who want to venture out into this area, please go through GLOBE rules. This is very, very important, and these are evolving, and there would be a teen number of changes, because even now all the 160 countries or so which are on target to implement this, still even then, they are, a lot of water has to flow under the bridge in this global minimum tax regime. So this is it from my side, and we would take in some questions. Yeah. So, oh, I think we have one question from Mr. Rungta. What is the difference between regime 1 and regime 2? I think you are talking about for trust, the regime 1 and regime 2. Now both are consistent. All the inconsistencies between 1023C and section 11 or 12A, they were streamlined in the last Finance Act. So now the only difference is under 1023C, in case you are an educational or medical institution, then you can go for 1023C. But now after this new Noble Society Supreme Court judgment, which is only for educational institutes registered under 1023C, right? All these institutions, educational institutions which are in 1023C registered, they have to consider whether to escape the wrath of this new Noble Society judgment, whether they want to shift to section 11 exemption, right? So this is the difference primarily. So friends, thank you very much for joining, and next month again we would be holding this kind of workshop with Tax Guru. Please do join us, and thank you very much. Stay tuned to our YouTube channel also, where we keep on sharing various updates. Thank you very much. Over to Moshmi.
Thank you, Vivek sir, for this wonderful deliberation. Thank you all the participants for attending the webinar. We conduct such webinars every month, and we hope we will get you in the upcoming webinars as well. We will shortly share PPT and video link to all the participants. Thank you.